Hey, good morning, options traders, and happy Monday to everyone. And great question for the group. I was speaking to one of our traders about how to calculate your return on investment after you've been rolling an option. So that can kind of throw traders. You're going, well, I've collected all of this cash. How do I account for my cost basis? Or how do I figure out what my return on investment is? And the reason this question came up is that he was looking at a trading service that had boasted all of these great returns, and we were looking at the calculations that they were using, and they're really not the way to calculate a return on investment. So let's go find out what this is all about, why traders get tripped up with it, what's the wrong way, and what's the right way to calculate your return after you've been rolling options. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, quick background on rolling. Remember that this is always about risk management. And what you're really trying to do is to reduce the amount of money that you have in the trade. And the basic idea is that you will roll your call options up and you will roll your put options down. And when you do this, it will always produce a credit. And so these credits are landing in your account, they're locked up safe. Doesn't matter what happens to the stock's price after this, those credits cannot be taken away, at least from that trade, until they get reinvested again. But from those rolls, they just sit there as cash. But if you had just left the options alone, now you've got an unrealized gain, and that can get taken away if you face an adverse stock price movement. So that's the basic idea behind it. And of course, this is also what causes the problems. Because what traders do is they look at their cost basis getting lowered, and eventually they're almost dividing by zero. And so a very slight gain appears to be 5 and 600% returns on investment. And it's really the wrong way to look at it. But this is what sets up the problem, is that they receive all of these credits. And unfortunately, they just look at it as though they are reducing their cost basis. And again, that's certainly okay from a risk management standpoint, but you don't want to use that cost basis when you're calculating your return on investment. So also remember, we've talked about this before, there's a basic rule of when to roll, especially for longer term options. So one of the basic rules is to roll when you can receive about 80% of the difference in strikes. So let's say that you own a $100 call and you want to roll it. Well, you do that by selling the 100 call and perhaps buying the 105. And if we look at this, that's a vertical spread, so you could put that in your broker's platform by selling the 100 105 vertical spread. But notice that there is a $5 difference in those strikes. So we take 80% of that difference, so 80% of that $5 difference is $4. And so the rule is telling you that if you can roll, or if this vertical spread is trading for about $4 or a little more, then it's time to roll. If that vertical spread is trading for $2, that's too early. You're really not doing yourself any favors by rolling that soon. Because remember, synthetically, you're paying the difference. If you roll for a $2 credit, you are synthetically paying a $3 debit. And that is pushing that break-even point out further. So this is a nice balance. We're getting 80% of that difference in strikes. In this case, we would be synthetically paying a $1 debit, but it's a good risk management technique. But again, unfortunately, what this does is because we're receiving all of this cash, it can make it very tricky for figuring out just how well you did with your investment. So the idea of rolling is graphically, from a risk management perspective, if we start off with a $100 call, maybe for $6, and we get $4 from a roll, we're going to just shift this red line up to the blue. I now own the 105 strike. There's our bend right there at 105. But notice my maximum loss is no longer 6. I've collected $4 from this roll, so my maximum loss is now 2. If I manage to pull off another $4 roll, now I'm above 0. I can say, well, I initially paid 6 and I've now collected 8. So the worst that can happen is that I've made $2 on my $6 option. And of course, the benefit here is that we have finally gotten ourselves above 0. So this is what some traders call house money, which is really a dangerous perspective. Remember, it's always your money. So we don't want to get careless with this and say that it doesn't count. But from a risk management standpoint, we've at least recouped our $6. We spent 6, we've now collected 8. And so again, the worst case that could happen is that if this final option goes to 0, well, we've at least made 33% on our money. Now, of course, rolling put options is just same idea in reverse. You might start off with a $100 put, say purchased at 6, you roll it for a $4 credit, roll it for another $4 credit, and eventually you get above 0. So now we're into this position where we just can't lose. So that's the background of the rolling and where all of these credits are coming from. But now the real question that we're trying to answer in this video, how do you calculate your return on investment? Is it fair to say that I have a 0 cost basis, and let's say I close this call for 2 and therefore I have an infinite % return? And yet that's what a lot of people do when they're calculating their returns with options after they've rolled. So let's go over to an Excel spreadsheet and take a look at the way that you should be calculating your returns when you are rolling. All right, so now we're into an Excel spreadsheet, and what I've done just to make the math easier is we're going to assume that we have an $80 call with the stock at 100, and the $80 call is trading for exactly 20 bucks. It's trading for parity, and it's just to make the calculations easier. We'll look at a more realistic example in a moment. But let's say here is the list of stock prices right there. So notice that if the stock goes from 100 to 105, that's a 5% increase in the stock. If it rises to 110 from 100, that is a 10% increase. If it rises to 115, that's a 15% increase, and so on. So if you own the stock at these different levels, you would be up 5%, 10, 15, and so on all the way down the line. On the other hand, if you owned the call for 20 and the stock goes to 105, that call is worth 25. It's just got 25 points of intrinsic value, and again, we're assuming no extrinsic value. So notice that you would have a 25% gain at this point. And that's because if you had sold it for 25 and you paid 20, that's a 25% increase. And notice that that increase, 25%, compared to the 5% return on the stock, is exactly 5-fold. Where is that coming from? Well, it's coming from our leverage. The stock is trading for 100, but you're controlling those shares for only 20, for 1/5 the amount. And so that's why we have this 5x leverage. So that's always going to be the same. I'm also going to assume that we are rolling 5 points each time. So we're going to start off with the 80 call. After the first roll, we go to the 85, then the 90, and so on. We're also going to assume that we are getting a $5 credit. Why? Because these options are trading at parity. And again, it's just to make the math easier and the calculations easier to follow. Now let's look at this column, our cost basis. This is what a lot of traders do. They'll say, well, I paid 20 bucks, and when the stock went up here to 105, I got a $5 credit from my roll, so now my cost basis is 15. I rolled it again for 5 bucks. Now my cost basis is 10. I rolled it again for 5 bucks. Now I've got 5 bucks into it. And if I close my call, which remember is currently trading for 20, and I've got 5 bucks into it, that's a 4-fold increase or a 300% return. Well, is that really the best way to look at it? And the answer is no, and that's because this whole idea of reducing your cost basis is okay from a risk management perspective, but you really shouldn't use it to calculate returns on your investments. So here's what we should do. Let's look at the total amount that we've received from the rolls. So just to make it clear, let's say we've done these 4 rolls right here. Stock is up here at 120. All right, so at this point, we collected 5, then a total of 10, 15, and 20. That's where those numbers are coming from. So we're up 20 bucks in cash sitting in our money market, but we are now controlling the 100 strike with the stock at 120. So if we wanted to close it, we could capture another 20 bucks right now. So notice that that's the closing price. That will always be 20 bucks. And that's because we're assuming that we're at parity. So at any time we can close it for an additional 20 bucks. So therefore, right here after this roll, my total gain would be 40 bucks. And that's the $20 of credits from rolling plus 20 bucks from closing that call is 40 bucks. And so if we say $40 divided by the $20 starting price, it's a double. That's 100%. But notice that that's exactly the amount we would have had we not rolled. See, if we just held the call here at 20 down to 40, we're up 100%. So those numbers should match. Again, assuming that we're trading at parity. And we can see that they do when we use this calculation. Now there's another way that we can show that this would have to be true by looking at what's called a chained return. So let's say that I owned the call at 20 and then sold it at 25. That's a 25% return, or a multiple of 1.25. I've made 1.25 times my money. If I then reinitiated a position at 25 and sold it at 30, that's a 20% gain. That's a $5 gain on a $25 base. So I've made 1.2 times my money. If I reestablished over here at 30 and sold at 35, that is a 17% gain. So notice that if I look at all of these, what's called a chained return, after this roll right there, that should be a double. And that's exactly what we're seeing here, 100%. So these chained returns have to match. And the reason for that is down here, just for some simple notation, let's say that price 1, in this case is our first starting price, 20 bucks, and I roll to price 2 at 25. And then I roll from price 2 to price 3 to price 4 to price 5, and so on. I can continue as long as I want. But notice that these are being divided. Notice that these cancel. These are on the diagonal. Those P2s cancel, these P3s cancel, these P4s cancel. We're just left with P1 divided by P5. In other words, 20 and 40. So that's why they have to be exactly the same. That's why that's 100%, and that's a twofold increase, or 100%. So what's the moral of all of this stuff? Well, whenever you're looking at your rolls, instead of saying, let's reduce our cost basis, again, that's okay mentally to help you figure out when you've crossed that zero line, when you've at least recovered all of your initial principal, that's fine. But when you're calculating your returns, you don't want to do that. Instead, just treat these as, let's say, a dividend from the stock. So we spent 20, I've collected 5, 10, 15, 20, and then I can sell it for, let's say, 20. So I've collected a total of 40. Divided by my $20 starting price is double my money. That's where that's coming from, or 100%. Right there. And so you can see that that's the only way that those are going to line up. But you can also see that if we came down here and said, for instance, my cost basis is 0, and I closed it for 20 bucks, I have an infinite percent return. Well, that's just not true. It's a very good return, it's a double, but it's not infinite. So the point is that you can see that when we're making this option trading at parity, it's just a little cleaner. But here are some prices from an option pricing model. And let's say we put those in instead. And then let's say we are getting $4 from our rolls. So if we go back to looking at these first 4 rolls right there, you'd be up 88% if you didn't roll. You just rode from $21 to 40 bucks. But you can see over here, it's 68%. So that's also showing you it's not 88%. Those rolls do add up. So you have to remember there's always a cost. So be very selective on your rolls. Don't roll just because you have a credit. But anyway, that's really what I wanted to show, is how to calculate your cost basis when you are rolling. Treat it just like you would a share of stock, as if these were dividends instead. All right, so let's close with a quick example. Again, the main idea is to remember to treat your rolls, all of that rolling cash, as dividends. So let's say that you buy a $100 call and you spend 20 bucks. And then after your first roll, you sweep $4 off the table. You get a $4 credit. After your second roll, same thing. Third roll, fourth roll. So you've got 16 bucks in credits. And then this last strike, whatever it may be, you close it and you get 10 bucks. You're going to get some price for closing that out. Might even be zero, but there's some price that you're going to receive for closing this out. So if we're going to account for that, we just have to put in whatever that closing price is. Now, here's the mistake that most people do. They'll say, let's look at the 16 bucks that I've collected compared to my $20 that I spent, and they'll say, well, therefore my cost basis is now 4. I spent 20, I've collected 16, I now have $4 into it. So if I close this last call for 10 bucks, my return is 10 divided by 4, or 150%. Well, it just isn't. That's the misperception. That's not the way to do it. What you want to do is to say you've collected 16 plus 10 is 26, and you initially spent 20. So it's 26 divided by 20, 1.3 factor, or a 30% increase. Still a great return, but it's certainly not 150%. So always remember, one of the takeaways from this video is that rolling is about risk management. It's not about getting your cost basis down to zero so that your returns look far better than they really are. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.